Welcome, everybody, to another episode of the Doctors Unbound podcast. I am so excited for our talk today with Dr. Brian Robbins. He has expertise in multifamily commercial real estate investing, and he's even written a book on the subject, and we'll get into that, I'm sure, before the show is over. Brian, welcome to the show.
Thanks. Thanks for having me.
Absolutely. We've got a lot to talk about today about multifamily investing and how that could be beneficial for physicians. But I'd like to start with your why. It was written in your book, and that really touched me. Why you got into investing and what you were trying to accomplish by doing so.
Sure. I guess kind of a little bit of my background. About 15, well, I guess it's been 17 years now, we adopted a family of Russian orphans, a sibling group of 7 kids, and we just really got involved with the adoption process and got exposed to a lot of the positives, a lot of the negatives, and my partner and I started this business really to help generate income for our families, but also to generate income that we could put into helping with adoptions, put into helping with orphanages, and then also with human trafficking. We kind of look at human trafficking as the modern day slavery, and that's one of the big issues. And so we would like to eventually be known very similar to Tom Shoes or Mercy Water. We'd like to be known as kind of that for the multifamily space, the guys that put back a lot of money into these different various charities.
Well, that's pretty awesome and pretty special. I've read an article just recently about human trafficking happening here in the United States on a commercial airline, and if it weren't for a flight attendant that was, actually very observant and noticed that there was a young girl in trouble, that girl would have, continued in that trafficking, and it probably happens, under our eyes a lot of times, and I think it's a very big issue.
Yeah, having young kids, it just makes my toes curl thinking about people who take advantage of folks, of young kids, and whether girls, boys, whatever, that can't defend themselves. And so, it's something I'm pretty passionate about.
Yeah, I think it's super important. I was reading your story and the fact that you adopted this family of Russian kids, and that kind of hit home because my family's from Romania. And, that's right there in the backyard. And, I had the privilege of growing up in this country. I was born in this country. My parents escaped the communism there a long time ago. But through our churches and our community, there's a lot of people that go back to these orphanages and they help out and things like that. So that really hit home for me.
Cool. Yeah, very, very good.
We'll move on into investing here in a second. You didn't always do multifamily investing. You tried some different things from reading your book. Can you maybe take us through a little bit some of your other ventures into investing that didn't work out so well?
Sure. I'm an entrepreneur at heart.
Sure.
I guess physician second, but I was looking for ways to develop passive income. I got tired of just you can only work so many hours, and when you have a big family especially, it's hard to leverage enough hours to spend with them and spend in a practice. And so I was looking for passive income, and one of the ways was to start additional clinics. And so while they were successful financially, it certainly wasn't passive income.
Right.
Just managing more employees, managing multiple locations, different specialties. We do multidiscipline pain management type care, and so we had different specialties mixed in together, and it was just tough. I mean, it just took a lot of time, and I thought, in talking with some folks that had been successful at it, they really talked about, this will be easy, and this will be, passive income, and by no means was it passive. So it was a good source of income, but it just ate my life up real quickly. So we decided to sell most of those, and we started with some commercial real estate that was not multifamily. We went that direction, and retail real estate can be good depending on your location. Unfortunately, my location is in South Central Virginia, and it's not the greatest of locations because of what happened with NAFTA, because of what's happened with the economy over the last 15 years. And so
Right.
retail spaces, a whole lot of them are empty. And so as long as you're full, it's a great opportunity. It only takes a loss of 1 or 2, 3 tenants, and you're in trouble. And so that's been a struggle for us. We still have that, but it's probably eaten up more capital than it has really produced it at this point.
And from what I
hope
understand,
down the road that Go ahead.
I was just going to say, just from what I understand, that's gotten tougher and tougher with the likes of Amazon and online buying going up and things like that. These strip malls and these kind of brick and mortar type commercial real estate investments are having a tougher time.
Yeah, they really are, and we found it to be the case. And we're looking at a bunch of different opportunities for ways to repurpose our building right now because of that exact thing. And I think the predictions, if you look at a lot of the experts that know a lot more than I do over the next 10, 15 years, it's just going to be more and more pressure on the smaller retail space, brick and mortar spaces to do other things.
Yeah, I agree. So you're kind of trying these different ways to try and figure out some passive income, and it seemed like none of it was working. Where did that aha moment come when you finally came across multifamily?
Well, I had a partner that we had both been looking at different things, and he had done more than I've done, and his risk tolerance level was much greater than mine was, and so he's invited me repetitively to get involved with his, I don't want to call them schemes, but different things he was doing and different investments. And some of them he hit home runs with, but there were lots of strikeouts too, and so I had turned him down repetitively, and then he brought this idea of multifamily, and we ended up going through a pretty significant coursework that took us over a year, and we worked with a company out of Richmond, Virginia, 37th Parallel, and they tutored us in the process, and it was like getting a master's degree in multifamily. And I guess the single most important thing for me was, well, two things. One is that everybody needs a place to live, obviously,
right?
So it's an evergreen industry. Number two was multifamily, because it's so stable, the banks will offer non-recourse debt, and that's a big thing to me.
And explain that to us exactly. What exactly does that mean? Because some of us may not know non-recourse debt. What does that mean?
Sure. That means that they can, if something were to go wrong, the bank could take the asset back, but they would not have any other recourse. They couldn't touch my personal assets of any type.
Very important.
Unless two things. Yeah, very important. Two possibilities when they could. If you committed fraud, then they can certainly come after you. Or if you've introduced environmental hazards onto that property, then they can come after you.
Gotcha. Okay, very, very important. They're non-recourse loans. Can you maybe take us through not necessarily a deal that you're looking at now, but maybe something that is very current? How would you go about assessing a multifamily investment? What goes into finding it, analyzing, closing the deal? What does that look like?
Sure. So the first thing is to look at your MSA. You're going to look at where you actually want to purchase property. And we are real careful about we've got about 17 criteria that we look at. So we want to be in a market that's growing, number one. So we look at net domestic migration. And so we look to see what's happening with the population count in a city over the last 5 to 10 years. And then after we look at the domestic migration, we look at job creation. So we want to be in a city where the jobs are being created. And most of this leads you to look at, by the way, most of the cities in the South are meeting a lot of these criteria. The Texas markets are hot, a lot of the South markets. But then we'll look at the job base in a city. If there's something like, if it's really, really heavy military, we're going to probably shy away from that because, depending on which political party's in power, a stroke of the pen could take care of a military base and then you could be in trouble.
I see.
So we're careful about that. Yeah. We also look at the market, whether it's a linear real estate market or it's a cyclical real estate market. So the coast, we call them sand states, California, Florida, some of those gateway cities, well, not gateway cities, excuse me, but those states, Arizona, Texas, those tend, I'm sorry, I said Texas, Arizona, New Mexico, those tend to be more cyclical, and there's a lot of ups and downs, and you can make money in those markets, but you better be catching them on the way up and not on the way down, or you're going to be in trouble. And so when you look at a linear market like the Texases, like the Alabama, the Carolinas, a lot of the southern states right now, they're more stable. Kentucky's one as well. And so you're not going to have near as much risk. And so we look at the market first, and then we look at the sub-market. So if you find a property that looks somewhat enticing, then you're going to look at the sub-market and see what's around it, and that's real important. You want to make sure there's good. We use something called Neighborhood Scout, and we look at the schools. We look at how they rank against the other schools in the city. We look at the crime scores. We'll look at the demographics for that neighborhood. The people in that neighborhood, the average income, they've got to make 3 or 4 times as a minimum. They got to make 3 or 4 times what your rent's going to be, and so you've got to look at some basic minimums for the income. And so we'll look at those things. We might look at something called Walk Score, and Walk Score kind of looks at what's really close to this property. Is there conveniences that the average renter might want? Like, are there coffee shops in the neighborhood?
Sure.
Are there great parks? Things like that. Is there a running trail?
I think I've seen that on Zillow.
Yeah. I think they have that. Sure do. So we're going to really assess the area surrounding where we want to buy something. And surprisingly enough, if you look at the neighborhoods where a Whole Foods has gone into, or a Trader Joe's, or that actually amazingly causes real estate prices to climb.
That's a good indicator, huh?
If you happen to find, there's a lot of millennials that want to be close to those kind of stores, so your occupancy rates might be higher in a multifamily property if it's within a couple blocks of a Whole Foods.
So I should be happy that one is being built here in my neighborhood.
You absolutely should. There's actually, they've commissioned studies to show over a 5-year period what your real estate property values will do if they put one in your neighborhood. So you're in a good location.
Very good, very good. Frisco, Texas is going up. It's going places.
Absolutely.
So it seems like there's quite a bit that goes into the analyzing of these deals. Can you give us an idea of what percentage of deals that you'll look at that kind of meet these criteria? Because it seems like it's pretty stringent.
Yeah, well, I saw on one of the crowdfunding websites the other day for multifamily, they had a picture of a funnel, and that funnel showed a 500 across the top. 500 deals go into the funnel. Of those 500, maybe 100 make the criteria for a closer look. Mm-hmm. Of those 100, maybe 20 will meet enough of your criteria that you're going to really take a deep dive into that property. And then by the time you whittle it down, you're talking 1 or 2 deals that you might really have a good shot at getting out of that entire, anywhere from 3 to 500 deals.
Wow, that's
so
thank you for telling us that, because that really kind of paints a picture of the amount of work that goes into, and the amount of deal flow that you need to have to end up with a reasonable property.
Yeah. If you make a lot of good contacts with commercial brokers, you can kind of short sheet that process a little bit, but it's still going to be in the 150 to 1 type range, even with having a lot of good broker relationships.
Gotcha. So it seems like for physicians, in like I said, I got through most of your book there. Let's say we think this is a good idea. Multifamily is a good idea. Getting a sense of this deal flow here, there's a lot of work, especially if you're a physician that's working full time to analyze that amount of deals. Then we're getting into the issue of the amount of capital that's needed to purchase these kind of deals. So it seems to me like there's a little bit of a catch-22 here, in that, okay, here's this great investment, but I'm not going to be able to tackle something like this on my own.
Yeah. So if you're talking about the capital required, so most of the multifamily properties that are 70 units or above, and that's what they consider kind of the breaking line for commercial. Mm-hmm. Once they're 70 above, you can get typically anywhere from a 68 to a 80% loan to value ratio. So if you've got a $10 million property you're trying to buy, you're going to have to come up with someplace in equity. You're going to have to come up with someplace $3 million-ish in that range once closing costs and all those types of things. If you're going to do a value add property where you've got to do some improvements to it, then you're going to have to figure out where that money's going to come from as well. And then you're going to have, in order to qualify for that loan, you're going to have a balance sheet that will you'll have enough to cover. I think the liquid requirements right this minute are enough to cover a year's worth of payments, and then you've got to have. Well, let's just put it this way: it's a large balance sheet. That's the easiest way to say it at this point.
So yes, there's a lot that goes into it, and even among multifamily, there seems to be, a lot of flavors. So is there a particular type of property or investment model that you and your partners focus on when it comes to multifamily?
Well, we really like so multifamily is broken up into Class A, Class B, Class C, I guess Class D as well. But A are the most recent products that have been built, and so those are anything about from brand new to about 15 years old. Mm-hmm. Class B is 15 to 25 years old in that range, and then Class C is below that. And so we focus mostly on lower end Class B that is located in a A-minus neighborhood. So a nice neighborhood that has an older product in it that has really good bones, that hopefully a lot of the outside has been maintained well, but maybe just hasn't had a freshening. Maybe it's still got that, that avocado green, nasty interior that reminds you of the 70s.
Right.
Because we look to do what's called value add type of a situation where we come in and we're able to do a facelift on the inside of the property, make it look, put maybe granite countertops or put new cabinets, new carpeting, new, upgraded hardware, those types of things, and make it so it's a nicer property for the tenants. And then it allows us to bump the rents up some. And so that's really kind of what we specialize in. Class B value add that's already stable. In other words, that's already got a good occupancy number. Mm-hmm. And that allows us to get the right kind of financing to be able to do this.
Gotcha. And do you all take on investors? Do you guys syndicate and bring in investors to invest with you?
We do. Yeah, that's kind of our model, is we take on investors and that they help. So what happens typically for us is the point you brought up is that many physicians don't have the availability of time to go out and do all this legwork, and so we look for physicians or professionals that want to invest but want a passive investment. They're not looking to actually be working on the property themselves, or they really don't want those 1 a.m. running toilet calls.
Right.
And so that's kind of what we're looking for. Yeah. And not only that, if I've done the single property or the buy, turn and flip and the rentals, and that's not a non-recourse product. You can't get non-recourse debt on that. And so between the time cost and then also the higher risk, having a syndicated deal for us is a better way to go, because that allows physicians to just, they can do due diligence on our property we've already vetted, and then they can sit back and place their investment with us, and they can be a partial owner of the property, and so they can reap all the benefits of owning property. And they can also then, as an owner, they, instead of just investing in stock where you don't get any of the actual ownership benefits, when you invest in real estate, of course, you get depreciation to offset income that's given to you. So that's a great part of multifamily properties as well.
So can you? So let's say this hypothetical investor comes in and they agree to invest into one of your particular deals. Can you give us kind of a little bit more of a step-by-step of what they can expect as far as returns and time horizons and things like that?
Sure. So with a typical deal in this space, the investor will come alongside. They'll find a sponsor that they can trust, find a syndicator they can trust, and once they've found that, then they look at a deal or look at 2 or 3 deals, and they pick the deal they want to invest in. And once they've gone through all the paperwork and we have to make sure that they're accredited and those types of things, the actual funding of the deal, they place the money with us right before the deal closes. That money is then used to purchase the property. They are now a percentage ownership in that property, depending on what amount they invest versus the total cost of the property. And then they'll get a distribution of what's called a cash-on-cash distribution. And so a property in this asset class may produce anywhere from 5 to 8 or 9 8% cash on cash is pretty typical range. And then that's one way that the investor makes their money back. Also, then you get appreciation of the property, and that value add strategy we were talking about previously.
Right.
When we are able to create more rent, more net operating income, then the value of the property goes up. And typically, we try to rehab our entire property in 3 years is our goal, in 3 to 4 years. And so we'll turn the entire property over, raise the rents in all of those individual units over that timeline, and then go back to the bank and ask the bank to do a reevaluation at that point, 3 or 4 years in, and we've created all of this additional value, and then we can pull that money out of the property as a distribution back to our investors. So that's another way they get money back, and usually that's a tax neutral event because it's just a refi, and then in anywhere from that 5 to 10 year window is typically where we will either, depending on what makes sense, we'll either sell and just return all the money back to the investors, or we will hold on to and try to use up all of the tax benefits, and then either decide to operate or sell and 1031 it into a new property.
So there's
1031 exchange.
Thank you for all that. There was a mouthful there, and I want to unpack at least some of it because there's some questions that came up for me. Sure. These sort of cash on cash, distributions or money that the investor will receive, is that a monthly, a quarterly type of thing? Number one, and number two, is that something that's preset before time, or does that depend on how the asset is performing?
Yeah. Okay. So first question, how often does that happen? Typically, for most sponsors, it happens on a quarterly basis.
Okay.
And that's how we do it. Now, at the beginning of a particular deal, you would want to check and read the paperwork, the PPM and the offering memorandum, and all the paperwork that comes with the deal. But your sponsor or syndicator should tell you right up front, look, we think that this is not going to produce any kind of dividend for the first 6 months or the first 8 months, or maybe it'll produce it from day one. So you should know from day one how your dividends are going to come back to you. And if it's on a quarterly basis, it should say that in that paperwork. And so that cash distribution is really based typically on how the individual property is performing. Uh-huh. But you might have it set up where there's what's called a pref, and that pref is a specific rate that's guaranteed by the syndicator to go back to the investors. And so some deals have those, and some deals don't have those. So it really is deal specific as to how that is handled.
Gotcha. And so now let's move forward, and let's say we're 3 to 4 years down the road, and let's say there isn't a sale, but there's a refinance. Does the investor then stay? Like how does that work for the investor if there's one of these refinancing events? Do they get some kind of cash back, or how does that work?
Yeah, so typically that's exactly what happens. They'll and again, I'm saying typically because this will all be spelled out in the PPM for a particular property of how these events will be handled, and this will be all laid out up front. So
really important to read your PPM.
Read that boring paperwork, yes, because that'll spell it out. But you should, if your sponsor is going to do a refi, you're going to be, as an investor, you're going to be getting a chunk of cash back. So that's what should happen in that situation.
Does that decrease your ownership percentage? I'm sorry to cut you off. Or do they maintain their ownership percentage, or does that fluctuate?
Typically, with most deals, and again, most deals read your PPM,
right.
But most deals it does not change your ownership percentage. Yeah, okay. Most deals.
Most deals, okay. Yeah.
So when I say industry standard, there's for every deal there's nuances in that deal. So again, you can't say often enough, read your PPM.
Right. And then obviously when the sale would happen, then the investors would enjoy, assuming that the property, the asset did well, they'd enjoy some kind of percentage of the profits on the back end as well.
Exactly. And so most of the time, a syndicator has, and this will be spelled out in the PPM as well, will have a earned interest that they will be able to earn in the property if the property performs well. And so in most deals, it's anywhere, it can be as small as 10%, it can be as large as 30 or 35% of that. But there's hurdles that the property has to clear before a syndicator sponsor can have any share, any split in those profits. But the property owners, the group of owners, will get all of their money out typically ahead of that syndicator sponsor getting money in the deal, or getting any percentage of the deal. And then depending again on how the PPM lays it out, at the end when it's sold, then the individual owner has the opportunity to either get his money handed back to him at that point, or if they happen to have another deal they want to flip over into, there's a huge advantage for doing a 1031 exchange.
Right.
And I don't know if you've talked about that on your podcast yet or not, but that's something that the IRS allows you to make an exchange for a like-kind property that's a tax-neutral event, as long as it's of the same value or greater. And so if you're able to take, if you, let's say you invested $1 and you made $5, that $5 is going to, if it's handed back to you all at once, you're going to have some pretty big tax consequences. But if you can take that $5 and now put it in the next deal, and you don't have to pay any taxes, you keep that money working for you, and you're just pushing those taxes down the road.
And you typically have a window, right, to find that next property and roll it over. I don't know if it's 3 months
Absolutely.
Or something like that.
I think it's like a 90-day window.
90-day
I think
window.
you have a certain number of days to name it, and you have a number of days to actually make it happen.
Gotcha. And with the caveat of reading your PPM, let's say some catastrophe happens and an investor wants to pull their money. Is there ever any way for them to do that? Or is that once you're invested, you're basically in for the ride?
Yeah, so with a lot of these, there are some allowances for that. And when I say the allowances, so you're in for the ride, but typically what happens is somebody could have an emergency. Let's say it's a family emergency and they need some money. They have the opportunity for the sponsors have the opportunity to buy back those shares. That's the first thing that happens. And if they haven't gone the full timeline, then they're probably going to buy those shares back at a discounted rate.
Gotcha.
And if that doesn't happen, then they may have the next opportunity. They may offer those shares to the other owners that are in this property.
I see.
And if that doesn't happen, then they can even, in some cases, allow them to try to offer it on the open market. So if the property is doing as well as it should, you're not going to have any problem finding somebody who should buy those shares.
Gotcha. So it seems like it is very important.
Most of these.
Go ahead.
I'm sorry to interrupt you. Most of these are going to produce, anywhere from the low to mid, and then many of them will even go into the high teens in total return. By the time you've added up your cash on cash, your principal pay down, your appreciation, just all those things, that's where you're talking about. So that's why it's not something you typically will have a hard time getting rid of.
Gotcha. So assuming that somebody wants to get into this type of investing, it would seem to me like that one of the important criteria is to find a sponsor or syndicator that you trust and is expert. So do you have any tips for the audience how one would go about vetting a sponsor?
Vetting a sponsor. Okay. So, this is the age of the internet, so everything's just about public. So if you're you want to look for a sponsor that, number one, you hit it off with, that their approach, the very first thing you want to do is look and see what their approach is to investing, and their approach is to a specific project. And so if that meets your time horizons and your goals, that's the first step. And then once you've done that, then making sure you check out all the references that a sponsor gives you. You want to make sure you know who you're dealing with. You want to make sure that they've got a good track record in their past history of doing business. You want to make sure that they're experienced. This asset class is a really great asset class, and it's probably one of the safest investments that we have in the U.S. right now, and that's why it's such a hot market. But probably the riskier part of it is the sponsor, and just making sure that they're good guys and they know what they're doing. You want to ask a lot of questions. You want to read the PPMs. You want to talk to people that know them. If you're going to invest in a property, you want to ask them, hey, can I come see the property? That's something that's too, because if you're going to put a big chunk of change in a property, you might want to go take a look at it, make sure it is what they say it is. And so there should be a timeline where you could go and visit that property with them. And so they need to have a lot of answers for any question you want to ask, and not be defensive. That's for sure.
Thank you for that. Is there, I'm sure people lose money in every investment. So what are some of the more common ways that people lose money in multifamily investing?
So I guess obviously an unscrupulous syndicator sponsor, that would be one way. If you invest in an unstabilized property, so if you go to say Frisco, there's probably a 95% occupancy rate in Frisco, Texas, in apartment complexes. And so if you're buying a Class C apartment complex that has a 65% occupancy rate, that's not a stabilized property. And so there's a higher level of risk with an unstabilized property than there is with one that's already got a lot of tenants there. And so that would be one way to lose money. Another way would be to invest in a neighborhood that's going downhill, meaning, not one that's actually revitalizing, but one that's really just kind of cresting. If there's a lot of crime in the area, if you're next to a Superfund site, if you're in a bad spot in Texas that floods, those are things.
Unfortunately, yeah. Gotcha.
Yeah, those. Hopefully, you've got all your ducks in a row, and you don't go into an area like that. But those are some of the things that can be a bad situation, I guess.
Do you ever worry with rents creeping up that even with multifamily you get to a point where maybe people will flip the other way and look more towards buying? It seems to me that millennials tend to want to rent more, and maybe that's kind of an overriding trend. But do you ever worry about the market and rents going up and kind of leveling off, or how do you gauge or account for that in your investing?
Yeah. One of the reasons that we're in the value add space is because it has a buffering effect. So if you're in Class A properties and the market takes a downturn, you may have a hard time renting those properties because of the cost associated with them. But the Class B properties are typically the middle of the road. They're a lower cost to get into. And when you have that value add component, so we know we're buying this property at a lower price, we're going to take its value and climb it up. That has a buffering effect on market changes and turns, because it's kind of like buying like an old Mustang. It's a classic. You're going to put a little money into it. You're going to be able to fix it up along the way, and it's going to have better value. If you bought one that's already brand new, when you drive it off the lot, you're going to lose some money. So positioning yourself in a position where you've got a conservative underwrite, you've got conservative lending, you've got a conservative sponsor running it, and you're not kind of overreaching. I think that's the best way. Back to the question with regards to the specifics of millennials. We've got baby boomers that are downsizing.
Right.
We've got millennials. Millennials is now the largest population group in the U.S., and then we've got migrant workers and foreigners that are moving to the U.S. in growing numbers. We kind of feel like it's the perfect storm for rental properties, and so we're not really concerned about that making a huge swing yet. 30 years down the road maybe, but we think the demographics are such that it's on a long upward climb, and we think home ownership's at a lowest point in many years right now, and we kind of think that that's going to continue just because of the economics of getting into a home. And millennials are taught even in college. I have a young son that just graduated, and he told me, he verified this, that they teach them in college, boy, don't settle down, don't get stuck in one location and one job, because you'll make more money by switching and hopping. And so it's kind of built into their psyche that buying a house is not really what you want to do for quite some time. So I feel pretty safe in working in the multifamily space.
Thank you for that. Reading your book, you kind of go through some of these examples of the value add. And what was impressive to me was how some seemingly small, as far as like capital needed to create some of these value adds, really turn into a large amount of value that is added to the sale price of that property. It was really impressive to me just to see some of these real world examples of how, doing some of these really smart value adds turns into a couple $1,000,000, pretty quickly. That was really impressive.
Yeah, it does. Yeah, that's probably the thing that, other than the non-recourse debt, that's one of the things I like about the business that we have the most, is being able to, just see that value add. We're looking at a property right now that it's a little different because it's not fixing something up, but the property we're looking at right now has a problem with utilities. And what I mean by that, it's not a problem, it's an opportunity for us. It's a problem for the current owners. They have a water situation and a natural gas situation where they're paying for all the utilities for the tenants. And so they're only charging the tenants a small amount on an annual basis for paying for utilities. And all the neighboring properties have already switched over to the tenants paying all the utilities. Mm-hmm. And so the market's used to the tenant paying for the utilities. And we looked at it, and right now it's costing them, they've got a net cash flow of $50,000 that they're losing in paying for utilities for the tenants. And all you have to do is just slowly but surely, as you sign new leases, just hand that responsibility back to the tenants. And they're used to, and you can do something called individual metering, where you get it set up so that, on the water supply to a particular apartment and to the heat supply, you can actually meter that amount of that utility they're using, and you can bill that back to them. And by that simple little investment of $200 or $300 per, well, for water, it's about a $300 investment for most places to get a meter set on there. And so for that $300 investment for all those units, we can suddenly create, anywhere from $1 million to $1.5 million in value, that when you go back to refinance down the road, you'll be able to harvest that.
Yeah,
so,
see, that's
it's exciting.
That's so impressive to me, how you make these really small changes, really smart small changes, and it turns into such a big amount on the value of the property. That's so impressive. Is there anything else that you would like to convey to any physicians or anybody else listening to our audience who maybe is considering multifamily? Any kind of nuggets of wisdom for them?
I guess maybe, the single family, I love these shows where they take these houses and they this nasty looking old rundown house in this decent neighborhood, and there's one right in Waco that's really popular.
Yep.
I can't think of it. Magnolia Farms. It's that group.
Yep.
And the Gaines.
Fixer
they
Upper.
do a phenomenal. Oh yeah, and they just flip that. They take that house and they turn it into this beautiful place, and I love that. But what they don't show or talk about is all the headaches associated with doing that with single family homes. And so, it's almost as much of a headache to buy a 100-unit property as it is to buy a single family home, with the paperwork and all the other stuff that goes into it. And so my suggestion, I guess, for physicians, and as I said, I learned by experience on these single family homes that save yourself the headaches and the hassle and just take a step up to, multifamily properties, because you don't need that experience buying single family homes and flipping them to set the basis for you to go into multifamily. It's just as easy just to start with multifamily. So that would be my biggest suggestion, is that, your time is valuable. Don't underestimate what that's worth. And, I would go straight for the multifamily properties and stay away from the single family.
And you touch on this in your book. There are multiple ways to invest. You don't have to just invest cash. You can invest through like a self-directed IRA, for example. I've done that before in real estate. So you go through the different ways that you can invest in your book. So do you want to just tell the audience really quick about your book, what it's called, and where they might be able to pick it up?
Sure. Well, to be honest with you, it hasn't been released yet. It's going to be released here in the next, probably 3 or 4 weeks, hopefully. It's called Done, The Professional's Guide to Double-Digit Returns, Multi-Generational Wealth, and a Worry-Free Retirement. And it'll be on Amazon. And so we hope to have it 100%. We're in the proof copy format right now, and we're just getting a few more blurbs from some folks to put on the cover and put on the inside, and then it'll be done. So I'm going to say in the 3 to 4 week range is when it will be available.
Perfect. Awesome. And once it's up, we'll link definitely to it in our show notes so people can find out about it and grab it over there as well. Where can people contact you if people want to get in touch with you? Where would be the best place for them to get in contact with you?
Yeah, Brian at wellingscapital.com. That'd be the easiest place.
Brian at wellingscapital.com. Okay, perfect. All right. Well, I think that about wraps up the show here. I want to thank you again for coming on. I know a little bit about multifamily, but I know I definitely learned a ton today, and I learned a ton from your book. So I would definitely recommend, if anybody's interested in multifamily, once the book is released, go out, pick it up. If you can pick up just one or two things from the book, it's well worth it. I definitely picked up more than that, so I would recommend it to our audience. So that's going to wrap this up. Thank you, Brian, for being on the show.
Thank you. Appreciate it.